Welcome to the January edition of This Month in Payroll for 2026, and Happy New Year. I am Alana Hayduck, a partner in PwC's Payroll Advisory Practice and the Outsourced Payroll Leader. Together with Claire Socio, we will bring you this year's payroll and workforce updates. This month, we will focus on Part 1 in our series of year-end preparations, a payroll code health check, an update on the protected earnings amount changes that applied from 1 January, loans to employees, what is considered a loan and the fringe benefits tax implications, and finally, 2 December decisions of the Fair Work Commission, the first in relation to the Social, Community, Home Care and Disability Services Industry Award, and the second in relation to the Health Professionals and Support Services Award. So let's get started. This is part 1 in our series of year-end preparation updates. As we get closer to year-end and the commencement of Payday Super, it is important to undertake a review of the current pay codes being used in the payroll system. This is to ensure, firstly, that the codes are set up correctly for pay-as-you-go withholding, superannuation guarantee, and single-touch payroll. Secondly, the codes are used for the same earning, allowance or deduction as they were originally set up and the usage has not changed. And finally, that any new codes have been set up correctly. You should also have a documented process for any new pay codes, and the process includes appropriate approvals and sign-offs. This process should include that the new pay code is added to your documentation for your pay code matrix. A pay code matrix is a living document which details all current wage codes, their pay-as-you-go, superannuation guarantee, and single-touch payroll mapping. The matrix should also include the payroll tax and workers' compensation mapping, which may or may not be included in your payroll system. You should consider how you are reconciling each pay period to the single-touch payroll report lodged with the Australian Taxation Office. It is important to ensure that the system configuration for each pay code is reflected correctly on the report. It is important to check that the correct pay-as-you-go withholding tables are mapped to codes, especially those that are taxed under Schedule 5, the tax table for back payments, commissions, bonuses, and other similar payments. You should also understand which method of calculation is used in your payroll software to calculate the withholding. Termination payments are complex, and how they are processed in the payroll software can differ. You should review the termination codes and ensure that they are set up to correctly tax and report based on the type of termination. Certain termination payments may also be subject to superannuation guarantee, for example, a payment in lieu of notice. You should review how this is set up in the payroll system and ensure the correct superannuation guarantee is paid. Moving on to protected earnings. From 1 January 2026, the protected earnings amount for child support deductions has increased. This increase applies to pay dates from 1 January 2026, and you should have received a letter from Services Australia to let you know the adjustment amounts for the calendar year. The protected earnings amount is the minimum amount of income protected to cover essential living expenses such as food and housing for an individual paying child support. You need to ensure that the child support deductions do not reduce pay below the protected threshold, and the deductions adjust correctly if an employee has variable pay components. Where the deduction is not correct, this may result in the employer breaching legislation and being non-compliant with a notice, and the employee's financial well-being may also be impacted. The changes mean that you should ensure your payroll system has been updated to reflect the updated rates, as employees may have less deducted per pay period. Once the update has been made in the payroll system, you should review each employee to ensure the calculation is working correctly. You should avoid any manual manipulation of the system, and you should communicate with the impacted employees. Now to a topic which at first glance may not seem relevant to payroll: loans and debt waiver fringe benefits. A loan fringe benefit arises where an employer provides a loan to an employee and charges either a low rate of interest or no interest. A low rate of interest is one that is less than the statutory rate of interest, also known as the benchmark interest rate. So where can a loan arise in a payroll context? Where an employer inadvertently overpays salary or wages to an employee and subsequently requires the employee to repay the identified overpayment over a period, or where an employee is required to repay an amount upon a certain event occurring, such as the repayment of a relocation allowance if an employee resigns within a specified period and the employee is given notice for the repayment. The taxable value of a loan fringe benefit will generally be calculated as the difference between the statutory interest rate and the actual interest rate charged by the employer on the loan balance across the fringe benefits tax year. Relevantly, the term loan in the context of a loan fringe benefit is quite broad. This means that the loan fringe benefit can arise where there is an absence of formal documentation that would generally be associated with the creation of a loan. Where a loan fringe benefit arises, consideration should be given to any available concessions or exemptions. The otherwise deductible rule may apply to reduce the taxable value of the loan if the loan is to an employee and there is a reasonable expectation that the loan will produce assessable income for the employee. If the otherwise deductible rule is not applicable, the minor benefits exemption may be available where the taxable value of the loan is below $300 and the loan benefit is provided to an employee on an irregular and infrequent basis. Additionally, other exemptions may be available where the employer is in the business of lending money to members of the public, or if the loan relates to certain employment-related expenses that are to be repaid in full within 12 months. Where an employer releases an employee from the obligation to repay an amount that is owed to the employer, a debt waiver fringe benefit will typically arise. The main exception to this arises where the employer writes off a genuine bad debt that cannot be recovered from the employee after reasonable efforts are made, and this write-off is made for reasons that are unrelated to the employment relationship. In these circumstances, a debt waiver fringe benefit may not arise if the employer can demonstrate all reasonable efforts were made to recover the debt and the write-off was made in accordance with company policy for debts owed by third parties. Employers should consider available Australian Taxation Office guidance on the writing off of bad debts when considering this position. It is important to note that the rules for both loan fringe benefits and debt waiver fringe benefits can be complex and can arise because of certain payroll actions. Finally, there were 2 Christmas Eve decisions of the full bench of the Fair Work Commission. Firstly, there was a decision of the full bench which clarifies the position related to work before and after a sleepover under the Social, Community, Home Care and Disability Services Industry Award. The full bench addressed whether, under the award, a sleepover is a rest break between rostered work and whether work done immediately before and after a sleepover constitutes a single or separate shift. This matter arises from long-running uncertainty in the award about how to characterise a sleepover and how to treat work performed immediately before and after a sleepover for the purposes of shift length, minimum breaks, penalties and overtime. The full bench found that the award is both ambiguous and uncertain about whether a sleepover is a break and whether the pre- and post-sleepover work constitutes one shift. The full bench proposes to vary the award to clarify that a sleepover should not be considered a break within a shift or a break between rostered shifts under clause 25.4, where work is performed immediately before and after a sleepover. Those work periods are treated as one shift. To recognise continuity benefits while addressing fatigue, the award will permit, by agreement, a longer ordinary hours shift of up to 12 hours, where the shift is performed partly before and partly after a sleepover, with no more than 8 hours of active work on either side. Work beyond the 12-hour ordinary hours cap immediately before and after a sleepover is overtime at the usual award rates. And finally, shift penalties will be calculated only on active work portions on either side of the sleepover, where they are actually applicable, treating each active portion separately for these purposes. The sleepover allowance continues to compensate for the sleepover itself. The draft determination to vary these provisions has been published by the Fair Work Commission. The second decision was also a decision of the full bench and was handed down in relation to the classification and rates of dental assistants, pathology collectors, and health professionals covered by the Health Professionals and Support Services Award. The decision is part of a broader review of whether certain classifications in 5 modern awards have been the subject of gender-based undervaluation. The key takeaways are: the Fair Work Commission finalised award variations to correct gender-based undervaluation for dental assistants, pathology collectors, and health professionals under the award. The changes include new or revised classification structures, adjusted minimum rates, and stage implementation. Dental assistants and pathology collectors, whose roles sit in the support services stream, 2-stage increases will commence, the first from the 1st of April 2026, with full rates to be operational by the 1st of January 2027. For the health professionals stream, there will be a new Australian qualifications framework, which will be introduced and phased in over the course of 5 years, starting 30 June 26 and concluding on the 30th of June 2030. The variations were held by the full bench to be necessary to achieve modern awards and minimum wage objectives. The changes are designed to help correct gender-based undervaluation in female-dominated occupations. And that's it for the January 2026 edition of This Month in Payroll. If you would like to revisit any of our prior updates, they are available on our website at pwc.com.au/payroll. And if you have any questions or need for support, please reach out to myself or your usual PwC contact. Until next time, have a great month in payroll.